Welcome to this video to help you price for profit. In it we'll be looking at what is profit, where it comes from, along with cost and pricing techniques to help you achieve your profit potential. So what is profit? Well, profit has three main ingredients: cost, selling price, and sales volume. Definitions abound for profit, but let's keep it simple. It's what's left over when you've deducted costs from revenue. Without this mechanism of profit, raw materials and semi-finished goods could not be bought in, people couldn't be paid, or machines bought. Also, shareholders wouldn't risk their money as there would be no dividend. Therefore, the profit concept is making a profit from the added value given to products and services. And it's important you know the added value that you provide. So where does profit come from? And what are the actions that deliver it? You have two activities: cut or manage costs, which means spend less and buy better, and add value, and in doing so keep existing customers, gain new ones, and get them all to spend more and do it more frequently. All too often businesses are unclear about their profitability. We made a profit of £200,000, didn't we do well? Yes, possible, but more information is always needed to get the true answer. Is it profit before tax or after? How are they performing against their size? What are the principal measures of this profitability? Is it turnover, return on investment, or other? How are they performing against others? Here are some questions to ask if you want to improve profitability. Can you increase prices, change the product or service mix, reduce investment, reduce costs? Can you increase your margins, increase your sales volume, or change your channels of distribution? Let's be clear, price feeds profit. Therefore, you have to have a clear pricing strategy and know the tactics you can use to feed that profit. All too often businesses go about pricing blindfold. Be aware of the factors that influence pricing. There are three major ones. These are the three factors influencing pricing: your objectives, your operating costs, and your market situation or share. It doesn't matter what you're selling. The right price is the price the customer is willing to pay for the experience. Let's look at three costing techniques: cost-based approach, break-even based approach, and competition-based approach. The cost-based approach. Cost plus pricing is the simplest method by just adding a standard markup to your costs. The pros and cons of this? Well, it's not really sensible as it ignores demand and competitors' prices, and it won't lead you to getting the best price. It's a case of unit costs and fixed costs not meeting. But it's a popular strategy as sellers are usually more certain of costs than they are of demand. If everyone uses this approach, price competition is minimized. Many see it as generating a fair return with no advantage being taken. Break-even based approach. Break-even analysis, or a variation called target profit pricing. Here the price is set to break even on the costs of making and marketing a product, or setting a price to make a target profit. The business tries to determine where it will break even or make the target profit it's seeking. Break-even charts are used showing the total costs and the total revenue expected at different sales volumes. Break-even is seen as fixed costs divided by the sum resulting from price minus variable costs. This approach depends upon price elasticity and competitors' prices. It tends to be an approach when there's low pricing which needs high volume. But it does force you to search for ways to lower your fixed or your variable costs to lower the break-even volume. Competition-based pricing. With going rate pricing, prices are based upon competitors rather than on company costs or demand. Smaller firms follow the leader. This approach gives little control over revenue, but going rate pricing is popular as firms often feel that going rate represents the collective wisdom of the industry and will be the price to yield a fair return. They feel it may prevent harmful price wars. Sealed bid pricing is about setting the price based on how the firm thinks competitors will price rather than on its own costs or demand. It revolves around expected profit, but it does make sense for firms that make many bids. But occasionally it's not helpful as it doesn't distinguish between probabilities. You may be offsetting a high chance of winning to gain a low profit. Here are 4 price positioning strategies based on the axis of price and quality. Where do you lie? Are you low price and low quality? Then that's an economy strategy. Are you high price but low quality? Then that's an overcharging strategy. Are you high price and high quality? Then that's a premium strategy. And if you're low price but high quality, then you have a good value strategy. So where are you in this matrix? At the heart of pricing techniques are 4 options. Skimming is where you go for high price yet low volume, and that's usually if you have a niche or a new product. Competitive is where you price the same as everyone else, and here service is your differentiator. Penetration is where you go below the norm on pricing, usually to build market share. And bundling is where you offer value-added items that make it difficult for customers to compare you with others. Charge your price. You are not in business to match the price your competitors set. You are in business to service your customers. To get your price, customers must perceive added value. To make pricing work, you need to be aware of the strengths and weaknesses of your pricing value. So where is your pricing value that you can leverage? Does it lie within aspects such as image, selling, marketing, research, brands, customer care, PR, awards, technology, customer lists, products, services, people, ability, memberships? Here's 7 actions to price for profit. Keep your price until the end. Open up the customer if you can. Make the buyer work hard for any pricing. Always sandwich your price between offers. Help avoid the cost penalties of not buying. Test market your prices one at a time. And always let him or her win something. You've now completed this video on pricing. Look for others on pricing, including getting more without increasing prices and how to sell quality at your price.